Reverse mortgage math. It's kind of confusing sometimes. People aren't sure exactly how it all works these days because there's been changes and things like that. But reverse mortgages are really a great product that you should introduce into your sphere of business that you're trying to do. So check it out, Reverse Mortgage Math. February 14th, it is Valentine's Day, so bring your loved one to this webinar. That's what you should do. That'd be an excellent Valentine's Day thing to do. There's a banner right here you see on the screen.
Is it on Valentine's Day?
It is. It's Thursday. Yeah, it's February 14th. Okay, so over on your right, scroll down a little bit. You click that banner to register, or on your mobile device, scroll all the way down. There'll be a banner there that you can register from, or there's a link somewhere around here.
Nothing says I love you on a 50-year anniversary like a no mortgage having house.
That's true.
That's totally true.
Yeah.
And I'll tell you one thing.
Yeah.
The math is not difficult on a reverse mortgage, but it's like any type of math. If you don't know it, it's Greek.
Right.
When you know it, it's like, oh, hey.
I get it.
There you have it. Yeah.
Yeah, let's do it.
They're not that difficult. You totally should look into this. Okay, so I just want to preface this. We are not being political here, so we're not picking a side. We talk about politics as it pertains to the housing industry.
Right.
That's what we do here.
So
now,
deal with it.
Now, there might be a slant because we do agree that deregulation is going to be better for things, and I think we've seen it. It's proven out over the past 10 years.
So we have a slant.
We do have a slant when it comes to housing. So just don't take this the wrong way, because I know half of you are going to say, oh my God, he's being political. Okay, so here's what we're talking about. Alexandria Ocasio-Cortez, you might know who she is, out of the Bronx.
I didn't know her.
Okay, she's part of the Senate, and right now she is going to be on the House Financial Services Committee with Maxine Waters, where they share the same views. Okay?
Okay.
And what they're going to do...
Off to a shaky start.
Okay, hold on a second.
All right.
What they're going to do is begin their march to re-regulate our industry, the industry that Trump deregulated, that Frank Dodd-Frank regulated, because deregulation before 2008 and the housing crash wasn't working.
Got it. I think I got you.
Okay. But speaking of which, I want you to understand this about this gal. Cortez was just 17 years old when the housing crash began.
Really? That's a trip.
17. Isn't
Wow.
that nuts?
It is interesting.
It's totally crazy.
Yeah.
But now she's going to be one of the most powerful regulators of the mortgage industry.
Okay.
And by extension, will have massive, massive influence on the entire real estate industry. So that's why you need to know this. Okay.
So I guess marching once again toward over-regulation.
Yep.
I mean, do we remember just a few years ago what happened when? Okay, so for example, there were 1,850 new banks created from 1990 to 2008.
Okay, so 1,850 new banks who provide mortgages were created during that period of time.
Yeah,
Okay.
at a rate of nearly 100 per year, right?
100 per year.
Okay, now from 2010 to 2012.
After that, during the overregulation,
5 new banks.
Wait, we went from what?
5 new banks.
We went from 1,850 to what?
5 new banks, right?
And what changed over that period was regulation.
Regulation,
Okay.
over-regulation, okay? So that was fewer than 2 per year, okay? Now that was due to, like we said, over-regulation, right? The same type of regulation that Cortez, like Waters, wants back. And now they got the keys to the car, baby.
So before all the regulation, 1,850 new banks were formed. After 5?
5.
We went from over 100 a year to 2?
Mm-hmm.
Regulation, deregulation. Oh, and by the way, Frank, so as the time we weren't creating new branches, I want you to think about this, okay? Over that same period of time, of 95,018 branches, 6,008 were lost between 2008 and 2016.
Okay.
So we were closing banks down while we weren't creating new ones. That represents over 6% of branches nationally. Okay. Now, of the losses of all these branches and banks that were closing down, 4,941, or 82% of them, this is during the overregulation, were in urban zip codes.
Gotcha.
And 1,067, or 18%, were in rural zip codes. Now, this was due to the type of regulation that we're marching back towards with Cortez and Waters. Because right now, guys, these two have the keys to the car to make this happen.
Okay, one more thing.
All right.
Of those banks that closed, several metro areas lost 15 to 25% of their branches. Okay. Losses were especially acute in Baltimore, Chicago, Philly, Las Vegas, and Detroit. These would be areas that serve densely concentrated areas of minorities and underserved communities, which means, as usual, the ones who they're trying to protect get disproportionately hurt through said help via their overregulation.
That we are marching back towards with Cortez.
Right.
So I want to dovetail on that point here. From the National Community Reinvestment Coalition, 25% of these rural closures were in majority minority census tracts. Okay? So minority groups are getting massively pounded from the overregulation.
Right.
The Hispanic population of rural banking deserts is 100% higher than in non-desert tracts. A desert tract is where there are no options
Gotcha.
for banking whatsoever.
Okay.
And no options to go find yourself a mortgage.
Interesting.
The Native American population, it was 55% higher. This again, because of the regulation that we're marching back towards. So what's the point, Frank?
Well, with fewer banks, we have fewer mortgage options.
Yes.
Obviously. When we have fewer options with the same demand, the price for what you sell does what? It goes up. Okay? Mortgages in our case is what we're talking about. Now further, those offering mortgages can be more discernible to those they offer mortgages to.
Right, you got a lot of demand.
That means hiring their standards or raising their standards. That means fewer people get more expensive mortgages. So get that? Fewer people wind up getting more expensive mortgages.
Oh yeah, and because minority groups across the board from studies by everybody, including the federal government, have lower average credit scores. So fewer minority groups will receive fewer mortgages from fewer mortgage companies in fewer locations at higher rates. We're marching towards this.
I mean, we just walked away from this scenario.
I know.
Right? And yet, once again, we're marching back towards it. Now, understand, more regulation has a more severe impact on minority and underserved communities. Period.
Yep.
We just showed you just one example, with new bank formations dropping off a cliff while at the same time existing banks have been disappearing. That's a double whammy.
Bang, bang.
And that hurts the real estate industry.
You.
And that hurts minority and underserved communities.
Yep.
Yet,
Here I go again.
And I want to say this is not about politics. I don't know what that gal wants to do outside of I've heard the 70% tax thing and free health care
Awesome.
and free education and guaranteed jobs with sick pay, maternity. I mean, I've heard all that.
Right.
I don't want to get into that. Just as it pertains to housing, this is going to hurt your industry. And it's going to have a big whammy on underserved and minority groups. You have to understand that.
so, put your head down and get to work, I guess. There's not a lot you can do about it.
Well-
But just know what's going on, vote appropriately, and do your best.
All right? We'll talk to you
All right,
later.
see you later.